What if I told you every market crash you've ever heard of, from 1929 to 2000 to 2008 to 2020, wasn't an accident, a glitch, or a failure of the system, but the system working exactly as designed? Imagine a stick-figure world. People running, markets falling, charts collapsing. And in the middle of the chaos, a handful of calm figures quietly preparing, waiting, and buying. Every crash feels like the world is ending. Yet somehow, the world always rebuilds. And wealth always shifts from the panicked to the prepared. Could we ever stop this cycle? Or are crashes a permanent feature of capitalism? Before we uncover the hidden mechanics behind market collapses, make sure you like this video, subscribe to Lazy Economist, and share it with someone who wants to understand how the financial world really works. Market crashes are terrifying. They wipe out savings, destroy jobs, bankrupt businesses, and spread panic across the world. But here's the uncomfortable truth. Crashes don't just destroy wealth, they reset it. And today, with inflation rising, debt piling up, asset bubbles inflating, and global uncertainty climbing, the question feels more important than ever. Can we actually stop market crashes forever? Or are we living inside a machine that periodically needs to break before it works again? To answer that, we need to understand what a crash really is, why it happens, and why every attempt to stop crashes has failed. This story goes deeper than economics. It's about human psychology, political incentives, and the hidden architecture of global markets. Let's break it down. Every financial system in history, ancient Rome, medieval Europe, early America, has faced boom and bust cycles. Why? Because markets follow the same emotional rhythm. Fear, hope, greed, euphoria, denial, panic, collapse, reset. When millions of people act on emotion instead of logic, prices disconnect from reality. Governments try to stabilize markets, but they cannot stabilize human psychology. As long as humans feel fear and greed, cycles will form. Modern markets react in milliseconds. A rumor, a tweet, a bad earnings report, and billions can vanish instantly. But systems like wages, regulations, and government policies move slowly. This creates a permanent imbalance. Fast money, slow systems, sudden crashes. It's like trying to steer a sports car with the brakes of a bicycle. Even with perfect technology, human uncertainty guarantees volatility. In the 1990s, central banks tried to suppress downturns. It worked, briefly. But each time they saved the system, investors took bigger risks. This created the dot-com bubble, the housing bubble, the stimulus bubble, and potentially the debt bubble we live in today. Stopping small crashes creates giant ones. A forest that never burns becomes a forest that explodes. When prices fall, weak companies die, debt gets wiped out, and stronger players emerge with more control. Crashes expose the difference between those who panic and those who prepare. This is why the wealthy buy during downturns, because they understand that crashes are temporary, but the opportunities inside them are permanent. Here's the truth almost nobody is taught. We can't stop market crashes, because crashes are the price we pay for a system built on innovation, risk, ambition, and human emotion. A world without crashes would be a world without growth. No startups, no investments, no technological breakthroughs, no opportunities. Crashes aren't the end of capitalism. They're how capitalism breathes. They clear out excess. They redistribute power. They reveal who is disciplined and who is fragile. You can't stop the cycle, but you can learn to survive it and benefit from it. So can we ever stop market crashes forever? No. But maybe we shouldn't try. Instead of fearing the next crash, prepare for it. Learn how money moves, how markets behave, and how to stay calm when the world is panicking. Crashes are inevitable. But losing everything during a crash is not. If you want to learn what they never tell you about money, markets, and global power, subscribe to Lazy Economist. Your financial clarity starts here.